Hi guys, welcome to my channel once again. This is Bar Talk with Ola and my name is Mujola Olu. I'm so thrilled to have you here once again. Today I want to talk about a very important topic that you would find very useful. But before I do that, don't forget to subscribe to my channel, like this video and all other videos on the channel, and please leave me comments in the comment section. By the time I get to the 50th episode, I'd like to dedicate it to questions and answers. That is, I'd like to answer all your law-related questions. So please shoot them at me at houseoflivingstones@gmail.com or leave them as comments on the videos. I'd like to do a full video answering all your law questions. Whether you're a lawyer, a layman, or a law student, leave me those questions and I'll be answering them on the 50th episode on this channel. Before I continue as well, I'd like to share good news with you. I won a book! Yay! I'm so thrilled to have won this book. Guess what I did to win this book? I counted 16 F's. Yes, I was in a training class during the week and we were asked to count how many F's were on the screen at some point in time. The aim of the exercise was to prove or to show that, even when people hear or see or read the same thing at the same time under the same conditions, they live with different perceptions and different understandings of that thing that they have all read at the same time and under the same condition. So some people counted 12, some people counted 13, some people counted 14, and only 2 of us in a class of about 30 counted 16 F's, and there were actually 16 F's on the screen. So as my reward, I won this book. I'm so happy. I'm always happy whenever I win anything, so I'm really happy that I won this book. I look forward to reading it and being better for it. So let's go on and talk about sweat equity. Sweat equity means equity payment or equity remuneration. It simply means delayed gratification, if I may put it that way. It's the means by which companies and businesses, give payments in kind rather than in cash. That is, okay, maybe I have done something for the business and they're supposed to pay me 50 million naira. Instead of paying 50 million naira, they are going to give me shares to hold in their company. So I become a part owner of the company as a result of what I've done for the business by holding sweat equity shares. That's the simplest explanation for that. So sweat equity shareholding is really good for startups and small businesses, especially those ones that have a problem with funding and with pulling enough funds. So for instance, the founders or the owners of the business could elect to get paid in sweat equity shares instead of normal salaries and bonuses. Likewise, staff, employees could be paid in sweat equity shares. It just means that if, for instance, you were supposed to get 100,000 naira per month as salary as an entry-level officer or staff of that company, because they do not have enough funds at that time, or because they have just chosen that model of payment, you are going to have a certain percentage of hold in the company. They are going to give you stocks of the company, but you're not going to buy it the way other people buy it. Instead, it's going to be an exchange of value. That is the value you are giving to the company. They pay you back in shareholding as opposed to paying you in monetary terms. So it's very useful and it's something that you can explore if you're a startup or if you're a startup employee. Is a very good means of remuneration that you could accept from your company or employer. But there are some things to consider and I'll go into them right away. Now, don't forget that the company gives you its shares in exchange for your time and your labor to the company. So you should look at, the commensurate value of what you're getting. That is, you should look at what you're giving to the company. Is the stock hold, is it commensurate? Is the sharehold commensurate to the value that you're giving to the company? You should totally look at that, and you should also look at if it will be possible for you to monetize it. If you would like to monetize it, I'll go into those things much deeper. And lastly, you should look at the future projections for the company or the startup. Will they scale, and will you be able to get the full value of the work that you're doing for them now, or even much more, so that you don't run at a loss. You should look at those things, but I'm going to itemize them for easier understanding now, and I'm going to explain them in much detail. Don't forget to subscribe to the channel if you have not. Turn on the notification bell so that you can get notified whenever I drop a new video. Let's talk in depth about what to consider before accepting sweat equity payments. I have narrowed down the things you should consider into 3 points. There may be more, but you should consider these things as of utmost importance. The first consideration is how viable is the company. You should look at that. How viable is the company? Is it a company that would fold up in 2-3 years, or a company that would survive the times and thrive, and go on to be successful? You should look at that so that you do not lose the work you have done and the expected payment at the end. Don't forget that I said that sweat equity payment is a delayed gratification. That is, you're postponing your payments until another time. That is, you're holding ownership. You are getting ownership, part ownership of the company in exchange for the time and the labor that you're giving to the company. So you should look at how viable they are. Is it a company that would succeed? What are their financial projections? What's their feasibility studies? What products are they offering the market? Is this something that would scale? Is this something that would be successful, so that when it's time for you to realize your sharehold, that is when it's time for you to probably liquidate or monetize it, will you be able to do that, or will you be running at a loss? There are people that bought stocks, normal stocks now in the market, not even sweat equity stocks now, just normal stocks, offerings. They bought them about 10-20 years ago, and today they have run at a loss because those companies have gone into extinction. Those companies are now defunct, and there went their money. So you should look at that. Even though you're not paying money for the sharehold now, you're paying value, you're paying in time, you're paying in labor. So you should consider if the company is a viable company, if it's a company that would scale, if it's a company that would thrive in the market. You should look at that. The second consideration is how rigid are the terms and conditions for transfer or liquidating your sharehold. That's very important, because usually one problem that usually comes with equity shareholding is that you cannot really monetize it or liquidate it the way you would normally liquidate other stocks, normal stocks, for instance. That's one problem that usually accompanies it. Sometimes they put stipulations and regulations that make it impossible for you to just liquidate at any time. And we wouldn't blame the company, because if, for instance, they have said that you cannot liquidate until after 10 years. What if they've not scaled in 10 years and you want to liquidate? That means that they are running at a loss. They have to monetize your sharehold and give it to you, which might be a loss for them and not really much of a benefit. But then it's holding you back too. So you should look at it. You should only take payment or promise of payment that favors you as well, even if you want to put the company in consideration. You should put yourself in consideration as well. So what are the terms and conditions attached to liquidating those shares or monetizing them? It could be that maybe you need the consent of a number of other major shareholders, or maybe before you can transfer it or liquidate your sharehold. Or it could be that maybe if you leave the job, you would lose your sharehold. So you should consider that. If, for instance, a condition is that if you leave the company within maybe a certain number of years, maybe if you leave before 10 years or before 5 years of working with them, you would lose your sharehold. Are you ready to make that sacrifice if the need arises? Are you willing to lose your sharehold if you have to leave the company within 2 or 3 years? Are you ready to lose your sharehold at any point in time if you have to leave before the stipulated time? You should look at that before you accept sweat equity stocks or shares. The third thing you should consider is, will the future value of your sharehold be commensurate to the work that you're putting in right now? You should always consider that. Yes, the company would scale. Yes, the company would succeed. But when it's time to probably monetize or to come into full realization of your sharehold, will it be commensurate to the work you're doing for them now? So you should always look at those three things before you accept equity, before you accept sweat equity shares as payment, for work done in any company. Now, anybody can accept that as payment. As a lawyer, you could a startup could ask you to be their company lawyer in exchange for equity sharehold. It's okay. You could work for them as a consultant, and they could ask that, oh, let's pay you in equity sharehold. It cuts across different services and different professions. It's okay for you to accept sweat equity shares as payment for your work, but you must consider the things that we have mentioned. I hope that you learned a thing or two from this video. I will always see you in my very next video. Toodles!